Welcome to Morningstar. China's zero COVID policy is affecting consumer confidence and sales growth of many consumer brands as cautious spenders avoid crowded shopping districts and travel destinations. As a result, many of these consumer brands are stuck with piles of unsold inventory. What does it mean for their stock prices? We're talking to Ivan Su, Senior Equity Analyst at Morningstar. Hi, Ivan.
Hi, Kate.
The macro backdrop remains very difficult for Chinese sportswear brands like Ning and Anta. How are they coping with the current situation?
You're right. The situation is very difficult because of weak sales that's caused by COVID restrictions, which has resulted in elevated levels of inventories. For almost all these sportswear brands, including Anta, Ning, and also Nike, Adidas, they've reported very high levels of inventory at the end of the third quarter. Now they are stuck with these inventory. So for them, top priority going into the fourth quarter is to provide more discounts to sell out these inventories in the fourth quarter. If you recall, the fourth quarter is also when China's largest shopping festival, Singles' Day, occurred. So all of these brands will be taking advantage of Singles' Day to clear down their inventory levels.
So how long do you think these price markdowns and discounts last? Would it go even to the next year?
I think it's highly possible that elevated discounts will go into next year. And that's because following a weak September, we are seeing very weak consumption patterns in October. And November we can also likely to see a continuation of that trend in November. So if demand's not keeping up, it's very likely that inventory clearance will take place much slower than what a lot of these brands are anticipating. Keep in mind that at the moment, the market still assumes a normalized pricing environment by the end of this year. But based on what we are seeing out of China at the moment, which is that we're seeing still a lot of COVID restrictions, it becomes less and less likely that these brands will be able to deliver their target of normalizing inventory levels by the end of this year.
So with all these, how are their profits and earnings level impacted for full year 2022?
Well, because they have to give more discounts, that means their margins will weaken. So we are forecasting a slowdown in growth and also a decline in profitability, at least for this year. It's uncertain right now whether that weakness will last into next year. But from our point of view, we think there can still be a little bit of further downside to share price, to valuations over the very near term.
So between Ning and Anta, which of them are the better pick and why?
Yeah, so we talked about the near-term uncertainties, but looking into the long term, we are still pretty optimistic about the Chinese sportswear industry. We still think this is going to be one of the fastest growing consumer category in China. And within the two companies you mentioned, we prefer Anta. And for the simple reason that, Anta owns a very robust brand portfolio. They have brands such as Arc'teryx, Solomon, Desante, some of the very premium brands that command respectable pricing power in China. We think these brands will deliver pretty spectacular growth going forward and very strong profitability as well. So this is the reason why we prefer Anta over Ning.
Right. Thank you so much, Ivan. For Morningstar, I'm Caitlin.